Chapter. We're talking real money.
The number one issue in all of our lives, day in and day out, is money. Other things may float to the top for a while, but day in, day out, year after year, the one thing we have to get right is money, because money fuels our life. It fuels our existence. And if you're not managing it well, dealing with it properly, you're not going to be enjoying your best life. That's certainly the case. Your best life. You can get by if you don't do it well, but it's better if you know what you're doing. And it's also better if you invest in a way that is truly good for you and your future. And that's what we're here to try to help you do. To do it the right way. Maybe not the most fun way, but the right way. And if you want a little help doing that, then give us a call at 855-935-TALK. That's 855-935-8255. And we've got a couple lines open for you right now. Investing, as I said, it's not supposed to be fun. Yet a lot of people treat investing as if it was a game, a very expensive game, it turns out.
Yeah, and costly to you in ways you may not expect, because so many of you call us and ask us, hey, what about investing in cloud computing, AI, financial technology, cybersecurity, airlines, etc.? Thematic funds. This has been a huge amount of growth in our industry over the last decade. Big money racing into the idea du jour. That's what we've seen. And
energy,
what does it all mean?
Gold, crypto.
Yeah, you've heard that too. Uh-huh. And these strategies are entertaining because they tap into that trend. Right? It's exciting. I've seen this. I've seen people talking about this. I want to put some of my money there. Sounds great, right? But it turns out that the numbers don't back that up. And remember, as Don said, what we're really trying to do here is to help you make more money and live a little less excitingly when it comes to the investing side. So,
well, because the exciting investing is generally, the excitement is due to a high degree of risk. I mean, think about it. You go to an amusement park, all right? The Ferris wheel or the merry-go-round, they're not very exciting. They're kind of, well, they're safe.
For me, they are.
They're slow. Okay. But the exciting rides are the tilt-a-whirls and the roller coasters, because there's at least an impression, a feeling of risk that comes with those. And that's what you tend to confuse with investing, is these risky, exciting, adrenaline-pumping projects you embark upon.
Yeah, and a new study by a CFA that writes about this at Morningstar found that, those exciting things over the last 3 years ending November 30th, 2024, they have actually lost around 7% in aggregate a year versus, for example, what if you're just in the S&P 500? You gained 11% a year over that span. That's a pretty large difference between losing money and making money. How did that happen? Well, a lot of ways. First of all, those things, the timing of those has to be so good, right? You have to get in before others recognize that idea. And then oftentimes you have to get out, or you buy things like ARC Innovation after it's gone way up, right? And then it has this horrible retreat that it's had. And I think it did make money last year, but certainly not the money that it made in previous years. So
yeah, but again, ARC Innovation is one of those perfect examples of a fund that is an absolute roller coaster. I want to pull its chart up. It actually, if you look at its chart, it looks like a roller coaster. Let's see. Oh my gosh. If we go back to 2014, you see it was pretty flat. Then it went down a little bit. Then it rose way up in 2018. And then it went down again at the end of 18. And then it went back up again in 2019. And then it went down again. And then it had a huge run up in 2021 and a massive decline that took it back lower than it had been in 2022. These kinds of things are not good investments but dang it, they're exciting. If you want excitement, go to Vegas. If you want investing, be dull.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Just to finish the thought on thematic funds, we do not like sector funds. We don't like thematic fund. I mean, which is just a new name for sector fund. Anyway, it's hotter.
Yeah, exactly. It's the same thing.
Yeah, but the lessons, the author makes it very clear. The lessons are thematic funds, as we just pointed out, have been poor performers. There's just no doubt that people buy trends and then they get burned. Part two is, according to his lessons, which I think he's right on, is people are very poor about timing their transactions. You just mentioned most people got into the ARK fund after the ARK fund had already skyrocketed, which is horrible. And then the third part is, and this is the part that I always forget, they're expensive. On a dollar-weighted basis, investors paid about 0.77 per year in fees on thematic funds. Now, you can go buy a global index fund for 1/5 of that. I mean, so why would you do that?
Way less than 1/5.
Or or
way
VT
less.
for less than that.
By the way, the fee on ARK Innovation is 0.75.
Right, pretty darn close.
And let me just give you two numbers, okay? I just want to give you two numbers. This will be kind of fun, a little game. Okay, the more volatile a mutual fund, what should you get? What should you expect from that fund? If a fund is more risky, long term, you should expect what?
Higher return.
Higher returns, okay. Yeah. Now, ARK Innovation does now have 10 years under its belt. So we've got a 10-year comparison we can do. Over 10 years, it's standard deviation, and that is a way to measure volatility. It's just a comparison. The higher the number,
and
the more volatile the fund is. ARK Innovation has a 36 standard deviation. Vanguard's S&P 500 ETF, VOO, has a 15 standard deviation.
I was going to say 15. I would have
15.
nailed it.
Okay, so which fund do you expect would have made more over the 10 years?
You should have expected ARK. But it ended up sinking instead of getting you safely to shore.
Well, no, actually, the 10-year average annual return was 12.87 per year.
On the ARK?
ARK, yeah.
Okay, ARKK.
But that's a far more dangerous fund than the VOO, the Vanguard Index 500 ETF, which returned over 10 years 13.51% per year, according to Morningstar.
And it was a good period of time for the S&P 500, no doubt.
And it was, along the way, it was a good period of time sometimes for ARK stuff.
And they're heavily in technology, which has had a huge run. So that's pretty good, pretty clear lessons there for anybody.
Oh,
sure.
So many clear lessons. I don't know why we have to keep repeating them. 855, because people don't listen. 855-935-TALK. That's our phone number. Let's go to Ottawa, California. Jeff, welcome to the program.
Oh, hi, guys. It's actually Jeff from Ottawa, Canada.
Oh, it's CA Canada. Oh,
Wait,
you're
the
in.
phone line works in Canada now?
It's hooked up to the same system now because it's becoming the 51st state.
That was a bad yeah, okay, so it's just you don't have to pay tolls or anything. That's so convenient. That's really good. By the way, we'll give you the address to ship into your tax revenue very soon, so stay tuned for that, Jeff.
I'm gonna let our screener know that Canada should be CN. Okay, good.
Rather than CA.
No, it's okay. I know you don't get many callers from.
Wait, we got to ask. No, we don't.
You know,
but we got to ask.
You got to ask what?
It was like 25 here today. I got to wonder what the temperature is in Ottawa today.
So actually, it's 4:18 p.m. here. So I'm on the East Coast. In terms of temperature, it's actually pretty mild. It's hovering around 0 degrees right now. So Celsius.
32.
I don't know how to do the Fahrenheit.
That's 32. Fair. Yeah,
that's
okay.
32.
You're warmer there than I am here.
It's nicer there.
Okay.
You were going to make fun of Canadians.
Yeah, okay.
Stop it. And he's not in the laundry room. Okay, Jeff, what's up? We've harassed you enough. I'm sorry.
I'm just driving around in my car and I was listening to the podcast and I thought I'd actually call in for once. I was going to ask you guys a boring question about bonds, but then I thought that I'd ask them a little bit more of an interesting question, especially given what's going on down there on Monday. You mentioned
yes. I'm not. I've
got to ask this.
Yes.
So I don't know if you guys are familiar with Mark Carney. He's the former governor of the Bank of Canada and also the Bank of England.
I personally am not. I know Don is more well-read than I am.
No, I've heard the name.
That I haven't even done that.
But I'm not really familiar. I know he's an economist or something, but I didn't know he was running.
He thinks our purchase of Canada is a bad idea, or where are we headed with this?
Stop.
Oh, I'm sure he probably does. But no, my question is, and I have a good idea what the answer is going to be, but I was just wondering, he's actually making a shift. He has no political background, but he's running for one of our main political parties here up in Canada.
Oh, that's where I heard it. He's going to run for prime minister, right?
He could potentially run for prime minister, right?
Okay, yeah.
And it's a very unique situation because everybody else who's leader of a party who's got a bit of a chance, they're career politicians, right? Mm-hmm. Mark Carney has, a background, like you said, down in economics. He's very well educated. Obviously a very smart guy. So my question to you guys is, and notwithstanding current politicians with financial backgrounds, capitalists as such, your new commander-in-chief come Monday is what I'm alluding to. How do you guys feel about people with no political background, specifically with backgrounds in finance or economics, who aren't necessarily capitalists, holding positions of power for a country or a state or a province?
Well, we got one of those here. In addition, the Secretary of the Treasury, I believe, will be somebody from the financial sector. He ran a hedge fund. How do I feel about it? Washington, D.C., you got to know where the bodies are buried. So it's tough for somebody to come in and kind of do things.
Uh-oh.
Apparently that was the end of that call. I'm sorry, I didn't mean to upset you.
So you gave him the wrong answer.
The right answer is people come from many different backgrounds, and I welcome new ideas all the time. How's that? Is that a good answer?
I love the idea. I truly love the idea of somebody with an economist's background and an economist's way of looking at things logically and based on academic research, on data. I think that's
trying to remember the last president we could really say that about.
I was racking my brain, running through my list of presidents, trying to come up with one, and I couldn't. I'm going to keep thinking, but I think that might be very refreshing because a good leader surrounds him or herself with people who have the skills needed to navigate all of the things that they are not proficient in. So I don't know Mr. Carney. Again, all I know is what I'd read an article or something about him somewhere. But hopefully he's smart enough to surround himself with people who have the skills to navigate the political fighting and issues in Ottawa.
That I will say, that aside, I will say that we just buried a president who came into that situation in 1977. It did not work out well for him.
Nope.
So these things are difficult, as I say, because they're very well established bureaucracy, parties, et cetera, that you got to come in and navigate. So, but sure, why not? In today's world, I think we should be trying something different because things are not working very well as they are.
Exactly. Let's try something new.
I agree. So
yeah. Thanks so much for the call. We really appreciate it. And thanks for being warmer than
kind of pisses me off. He's warmer there than I am here, but okay.
All right. 855-935-TALK is our phone number. That's 855-935-8255. It's really easy. It's really free, and it's really about anything that's going on in your life that has something to do with money. And as a matter of fact, please remember, here or in Canada, that generally speaking, the leader of the country doesn't really have a lot of long-term impact on the markets. So keep doing what you're doing.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
I love breaks in that they give me an opportunity to do some research. And I thought, if he has a chance to become Prime Minister of Canada, I should know more about Mark Carney. So I looked him up. 2 degrees from Oxford. Well educated.
Yeah, but that's not going to help you governing.
No. But he ran he used to work for Goldman Sachs.
That might help.
He was the governor of the Bank of Canada. That's the country's central bank. And get this. This is actually the most impressive thing on his resume. He was the very first non-Brit in the 300-year history of the Bank of England to ever serve as the governor of the Bank of England.
And I think
first non-Brit.
Now that you okay, all right, that's
Pretty
a good
impressive.
CV. That's a very good CV. So I'm going to go ahead and say it now. We're going to let him be the governor of Canada once we acquire Canada. Then okay, so
He's been a governor twice before.
You can be the governor.
So he's got governor experience.
Perfect. Thank you, Governor Mark. Good luck.
And the 51st state. Come on, that's insulting. If we were to acquire Canada,
I'm going to insist as a Puerto Rican that Puerto Rico comes before Canada. No offense, because we've been available for like decades. We want that first. Then you can deal with the North.
You guys haven't voted.
Yes,
overwhelmingly
every time
for
the vote
but
comes
is it
up,
overwhelming?
Yes. No, it's like 60-40, but it's which is overwhelming. Every time the vote comes up, they vote yes.
And Canada, but what I was going to say about it, it's insulting to say it would be the 51st state. Plus, it would be big if it was the 51st state. It should be
you want to
the
divide it up into
51st through 61st.
Wow.
Because there are 10 provinces.
But half of the people we're going to have trouble understanding. So it's...
What? A boot? I can understand a boot.
The French speakers.
Oh, the French. We have a sizable percentage of the United States speak Spanish.
Well, that may be true, but okay. Well, good luck. We'll see how this goes. All
right, we'll see how it goes. I don't see this happening.
No, I don't think it's
I'm making light of it.
Me too. It's very funny.
855-935-TALK. That's our phone number. Call. We'd love to talk with you. Let's go to... Oh, wait. Is that the same Jeff? All right, he can come back for a moment since he's from Canada. He has a follow-up question. Jeff?
Hey, guys. Yeah, sorry about that. I just got cut off. But, yeah, thanks for taking my second call. I just got the tail end of you guys commenting on my previous question.
We like Mark.
We think he's going to be a very good governor of Canada. We're okay with that. He has our vote.
Yeah, so... we're finding it pretty funny up here, Mr. Trump's comments, but some people are actually taking it seriously.
I know. Anyways, I shouldn't make light of it. Yes. Okay. Go ahead.
Yeah, I won't ramble on too much longer, but I wrote into you guys a couple months ago, and my question was about my blue chip stock portfolio that I had invested with a financial advisor, and at the time I was thinking of taking it all over myself, which I did do. I had to do a lot of trading because, if you remember, I was in quite a few large blue chip, high dividend yielding stocks. So I had to do a lot of trading. And I got a portfolio now where I'm invested in a few ETFs that are performing quite well. And I've succeeded in doing exactly what I wanted to do, which was mostly thanks to your advice. So I just wanted to thank you both. Oh,
that's very kind. Did you? I think Don had suggested that at least half of the money go into BlackBerry. Are you still holding on that position?
Mr. Obama, he was a real fan of BlackBerry.
I was too. And my great-grandfather loved the horse and buggy, I think, if I remember right. So
Would you quit making fun of Canadian institutions?
I'm sorry.
By the way, I made a lot of money off of Research in Motion as the voice actor for their conferences.
One of the few people that come out ahead on that one.
I came out ahead. You have anything else, Jeff?
Jeff, thank you.
If I don't get rid of you, he's going to keep harassing you.
I'm sorry. I kid because I care. That's why.
Spit take.
I think we lost him again.
I think we lost. Well, he hung up on
bank. I don't blame him. Okay. There goes our Canadian listenership, Jeff, and whoever else was there. So that's
the part of Canada that really gets cold is the same part of the U.S. that really gets cold, and that's the central part. Yeah,
right.
Yeah. I mean,
stuff comes down from the
Alberta, Manitoba,
Vancouver's pretty warm. Blah blah blah.
Yeah. Saskatchewan. Forgot Saskatchewan for a minute. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Pledge to make no more insults at our friends to the north.
Come on. You want to get insulted by Tom. Call us. at 855-935-TALK.
Don Rickles is dead, but the tradition lives on.
855-935-8255. Pay no attention to the man in the laundry room.
Very threatening, yes, because I might put you in the spin cycle. So
that's a gigantic dryer. I don't know if
a big dryer. Yeah, could put it in there.
So yeah, let's go to Puyallup, which is just fun to say. Puyallup. Larry, welcome to Talking Real Money.
Good afternoon, gentlemen. I called in a couple of weeks ago about getting a better return on my 401k. I have it in a stable value fund, getting right around 3%, 2.75%, somewhere in there. I had $50K in Boeing, and you told me to sell that, which I did. I made a little bit off that, $3,000. So you told me to go to a Roth IRA, if possible, and I shopped around. I found one for 5-year one, putting $200,000 in. That would leave me with $161,000 left in my 401k. At 5.2% for 5 years, it would pay me
it's a CD
of $52,000.
It's a CD.
You're putting your Roth in a certificate of deposit. Is that what I'm hearing?
Yes.
That's what you recommended me to do. I have not done that yet.
Oh, no. I think you misunderstood or
unless
something.
You don't want to have any exposure to stocks, then
I'm confused. Did you want again, I don't remember the call. Did you want absolute safety for that money?
Well, it's pretty secure now. I mean, I'd take maybe a little risk.
Where is it now?
Well, it was in the stable value.
Oh, it's in the stable value. Okay.
Yes, that's
again, I don't remember the call, but I guess if you wanted absolute safety, it's better to make 5 than 3.
Yeah.
Yeah.
But we do not we don't favor Roth IRAs holding those kind of assets.
Well, it depends. Again, this is where it gets so complicated. Yeah, because we're working from a position of ignorance. We don't really know anything about you other than apparently you want low risk, right? Again, I don't remember the call, so I apologize.
Yes.
Okay, but going back to your plan, which I'm certain you have, that tells you how much money you need to make on your money to sustain yourself and your family the rest of your life. What kind of rate of return do you need on that money?
Well, 4%, 5%, somewhere in there. But what I'm getting at, I was going to do this, so I called in and talked to Fidelity about their rollover, and they wanted me to take out $1,287 first to be taxed on, and then they would put that money in my checking or savings, and that was IRS Form 4P.
They want you to withhold something to move the money from a pre-tax account to a Roth.
Okay.
Because you're going to pay tax on that transaction, yes.
Oh, so that's what that's all about.
That's basically income. If you move money from an IRA or a 401k, a traditional, to a Roth, that's just like taking income.
Well, why would they want me to take $1,287 out and then tax me on it, then put it in my checking or savings?
That I don't. That's an odd. I don't understand that part of the transaction, but I could see why they'd want to withhold money because you have to pay tax on it. Giving it to you and putting it in your account, I don't get that.
Well, you don't pay the taxes on it until it's time to pay the taxes.
But generally, when these things are moved, they do withhold. They withhold
and send it to the IRS.
Yeah. Yep, correct. So that's odd.
Well, it'd be a rollover into an IRA, but I don't see why they want $1,287 and then tax that 10% and then put that in my checking and savings. So I didn't.
I got to tell you, Larry, I am baffled by all of this. I would have to go. I would have to go all the way back to square one with you, and start literally from scratch, because none of this sounds logical, well reasoned, and it doesn't sound like it's part of a plan of any kind. So I tell you what. I am. Stop it. I know. I'm going to ask you to hold on for a minute and just let's clear the whole thing. Let's start from scratch. Think about what you want this money to do, where all your money is now. We'll be right back.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
You, right there. I'm looking at you. Sit there patiently.
And listen.
You are so impatient. We're talking to Larry, and we need to start over.
Okay, all right, go.
You are so impatient.
All right,
okay,
go.
Larry, let's start at the beginning. You have what kind of accounts? Taxable, IRA, Roth, what do you have?
I have it in stable value fund.
No. What kind of accounts do you have? You have a Roth IRA, correct, or not?
Well, I have a small one of $10,000 in it, matured,
and then you have your 401k from work, right? Which has stable value in it. Okay, and
how
what
much
other?
Is in that?
How much is in there?
It's 361,000 in there.
Got it. Okay, and do you have any other investment account?
No, other than checking and savings.
Okay, perfect. All right, so now this $370,000 roughly that you have in your retirement accounts, what does that? Yeah, but you also have some in a Roth, plus 10 in a Roth. So I'm just lumping them all together.
Okay, I got you.
How much money does that money need to make for you in retirement?
No, I'm going to argue with you there. How much money does he need to take out of that regularly to pay the bills?
Okay, how much money do you need to pay the bills over and above whatever you're going to collect in pension or Social Security?
Okay, I've been taking $2,000 out a month, clearing $1,800, and you told me I'd run out of money in the future. So what I did, I called them when I was talking to them the other day. I lowered the amount I'm withdrawing to $1,500 a month, and I'd get $1,350 back instead of $1,800, and that would make it last longer in there. So
don't make it last. Okay, but I'm going to be a little impatient. Don's going to be mad at me, but here's the thing here's the trade-off that you need to understand. Because this money needs to produce, let's just say you live on $1,500, fine, and it has to last the rest of your life. You need to take a little bit of risk with it. You're not taking any by just having it all in CDs or stable value. Because that's not going to produce enough over the long haul.
But that's what I'm trying to figure out right now. Because if he has 360,
$370
at a 5% withdrawal rate, that's $1,500 a month.
Yeah, that is.
That's $1,500 a month.
But you're not getting much growth above inflation there with that.
Right. That's what's going to happen is inflation is going to start to eat you alive.
Yep.
So, but Tom, you can't, if somebody is going to panic out of any equity investment they have, then you either have to lower your expectations or raise. Here's your choice, Larry. You can lower your expectations.
20% in stocks,
or raise
20%
your risk.
I understand. I agree with you on everything you just said.
Okay. All right.
But I'm just saying at least a little exposure to equities, not all in CDs or stable value. That's all I'm suggesting.
Yeah, I believe that's probably going to be necessary. But so what you might want to do at Fidelity is get their, a total market index fund of some kind that gives you U.S. and international, and then I would not do a 5-year CD, though, because you're locking yourself in. I would do a ladder, or I would do a bond fund, like their total bond index for your fixed income. Then I would set up the portfolio to take out no more than 5% of the portfolio's value each year.
Yeah,
at the beginning of the year, as opposed to a set amount of $1,500. Because now what that does is it gives you a little growth component to help you keep up with inflation, as Tom was asking for. It gives you a high degree of stability in the bonds of the CDs. And then this way you can't really draw it down to zero because you're never taking more than 5% of the portfolio's value in any given year. And that tells you at the beginning of the year what your budget looks like. In a good year, you could be taking out more than $1,500 a month. In a bad year, you could be taking out $13 or $12.
Okay, but you still need to resolve this issue with Fidelity. I don't understand. I don't know that I'd be in favor. So it sounds like maybe you're making a Roth conversion.
I would not move to a Roth.
I would have it in an IRA. I would have 20% of it in the Fidelity Total World Fund, whatever that is, and 80% in the Fidelity Total Bond. So it's fairly conservative, little exposure to equities, and the hope would be that makes 6 or 7% a year, which is probably pretty generous with that little in equities. But the hope would you make that stays ahead of rising inflation. You continue to pay yourself out of that portfolio.
So 80% total bonds, and what was the other one, sir?
20% total stock market.
Fidelity has some sort of total stock.
Yeah, and
portfolio.
do not do a Roth. Do not do a Roth.
Do the conversion.
No, don't do a Roth conversion. Just put it in a regular move all of it over from the 401 to your Fidelity IRA.
Yep.
Then do it in the IRA, because there's no benefit to you in paying the taxes now as opposed to waiting until you take RMDs.
What do you think of a ladder bond fund?
I don't dislike a ladder. The only problem I have with ladders is that it requires a ton of discipline.
Okay.
It's harder work.
I don't know that you need that either, by the way. I think you'd be fine with a bond fund.
It feels safer.
It does.
That's all it feels.
Keep it simple.
Okay.
Be very low cost to do this.
What's the bonds paying now, roughly?
4.5
something, yeah.
4.5. Okay.
Mm-hmm.
Does that fluctuate much? I'm not up on bonds. Does that fluctuate much?
Yes, that will fluctuate. Yeah, that will fluctuate. But it won't. Okay, but it won't fluctuate like you're thinking fluctuate.
Thank you.
It will go up a little. It will go down a little, because remember, as the fund. As old bonds come out of the portfolio, as they mature out, they're going out and buying new bonds at prevailing rates. But in a fund like a Fidelity Total Bond Index, the average maturity of those bonds is about 7 years. So you've got a bunch of old ones that stay in keeping the rate up if rates fall. And if rates are rising, you got a bunch of new ones coming in to start to creep that rate up. But it's not going to move like you see rates move on Fed funds or those kinds of things. It will not affect that. This is a market movement.
Okay. Is 4.5%? Is that real low, or is that kind of medium, or what's usually the high?
Well, actually, right now, the Fidelity Total Bond ETF, which is what I would suggest, by the way, which the symbol for that is FBND. FBND. Yeah,
yep.
Like F bond.
Bond. Yep. B as in boy.
And it is currently paying 5.1%.
But that will fluctuate. There's no guarantee to that. The idea,
bit.
again, here's what we're really trying to do for you is build something that doesn't take a whole lot of work, is going to give you enough, I hope, to keep you sort of ahead of inflation and allow you to make a pretty healthy draw on that money that you need to pay the bills.
Is that FBND?
Yes, sir.
That's correct.
Okay. That's a bond.
Yes, sir.
Okay. All right. Well, thank you, and I'll. You've been a big help. You finally figured this puzzle out in my mind.
It can be confusing, and it is. That's why it for so many it is important to have an advisor. It just gets so confusing.
Yeah.
Thanks so much, Larry. Real quick. We only have about a half a minute.
Okay. Do you have any idea why they would want to hold $1,287 out?
Nope, but they won't anymore. If you don't do a Roth conversion, they shouldn't want to withhold anything. So don't worry about that. That should become a moot point. Thanks so much for being there. Remember our number. It's 855-935-TALK. You can call every Saturday, noon to 2 Pacific, 3 to 5 Eastern. Don't go away.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hope I get a better grade for that one. I didn't insult Canada. I wasn't impatient. I was kind of best behavior there. So
you were?
Yeah, that's me.
You actually call that your best behavior?
That's me being good. So yeah.
Okay. Here's one of the things that we can't emphasize enough when it comes to managing money is that the answer cannot be as short, sweet, and simple as many would like it, Tom included. There is a high degree of individualism and complexity to these issues that has to be explored. And I'm telling you, sometimes within the confines of what we do, that exploration can be difficult.
Tedious?
Well, no, not tedious. That's from the impatient side of you again. No, not tedious, but it's just the time constraints we have. Literally, an hour of the show is 37 minutes long.
Yeah, it's not that much time. That's true. Okay, fair enough.
But
so
that's why what I was getting to.
Yes?
There's a mess.
Impatience.
This is why. When did we start this show?
I don't want to remember, frankly.
It was a long time ago.
Yeah.
When we started it, because we'd been experienced doing other podcasts and shows for a long time, we realized the constraints under which we operate, which is why way back in the old days when we started Vestory, we told our advisor, which at the time was just Tom, that
Jim Whips too.
Oh, Jim Whips, that's right, Jim Whips.
Yeah.
That we said, please meet with people without any expectation of them ever becoming a client, because we need to be able to give issues like Larry's time.
Yeah.
We needed to. And that's why we came up with you can book time with us for free for nothing, and you won't get a high-pressure sales pitch. We guarantee it. Promise. All you do is go to talkingrealmoney.com and click on the Meet an Advisor button and set up an appointment. Now, some of the advisors for our firm don't like doing that. So they don't with the whole firm.
Oh,
the bigger firm.
Outside of the Seattle area.
Outside of the Seattle area.
Okay.
Yeah, because
sadly,
you've whipped them into shape in Seattle.
Okay.
Dude. You have less power
much whipping,
elsewhere.
but yeah. Okay.
But let me tell you, we've been doing it for more years than I apparently can count, because I can't remember now. But a lot of people have come away with really great direction as to where to go, even if you never use us as an advisor. A couple of things you will know. You will know more about where you're going financially.
Yeah, most people don't know really what they're doing they don't know what their portfolio is really made of.
Everybody wants a fast answer.
Yeah, they don't really know what a plan is. They don't all those kind of things. So yeah, we give you all that in an hour of our time. Now, it's not many people send me their stuff and say, okay, so am I looking okay? Well, as you said, it takes more than just that, but yeah, it's a good start. Let's just put it that way. So we're happy to do that. Sometimes we can study a portfolio. You can send it in. We don't have to sit down with you for that whole time. We spend some time looking at your portfolio. We can go, yeah, you're on a pretty darn good track based on what we know about you. Now, will we know this is going to be successful? No, we don't know that. But we know what has been successful in the past, and we want you to try to emulate that, knowing what you know about you and what you're going to tell us about you. Because we're not going to say ever, buy this right now because it's hot. We're not going to say that. And you can do that at talkingrealmoney.com. Contact form. If you want to see us live and in person, you better get your tickets to Retire Meet right now. They're going fast. Go to retiremeet.com. Retiremeet.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Oh, I think I need a nap.